Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Gary Mozer with us, and Gary has gone through a variety of different iterations. I think you've been reincarnated in the business world several times. So Gary, it's great to have you. I'd love to hear how you got from Chicago to LA, let's put it that way, into IPA. So great to have you.
Yeah, I went to grad school and studied real estate finance and master's in each, and then went to Wall Street. They didn't treat me well in the interview, so I said if I could go anywhere in the country. So I was going to California, wound up in LA at a company called George Smith Grubb and Ellis. And then we bought our company back in 92. I became one of the founders. By 98, I was the CEO of the firm. Decided I didn't want to run the company because I'd rather do deals. So gave up the title and just one of the co-founders and managing directors and just a deal junkie. I stayed with them 38 years until we sold the company a couple of years ago and joined IPA, which is the Institutional Property Advisors, which is the institutional group over at Marcus & Millichap.
Fantastic. And so you work with one other person in IPA, right?
I have a team, but we're capital advisors. We make the capital markets more efficient and create relationships for debt and equity for our clients.
So given the current situation with high interest rates coming due, what's your sort of current outlook on debt and refinancing these days?
There is more capital than there are deals. We're seeing the spreads on commercial real estate come in anywhere from 50 to 100 basis points. We're an agency lender, so today you can get to normal 65% loan to value, 125 30-year amortization at 140 over treasury. So you're talking about low 5% money today. So we used to be 170, sometimes it was 200. We're just seeing spreads come in. Same thing with bridge loans. We have a bridge to agency where we're seeing it prices tight as 175 over as you have a transition to that agency execution. But spreads have come in across the board from the life insurance companies, the banks, the debt funds. We do some back leverage with the debt funds, and the back leverage has gotten cheaper, so their spreads have gotten cheaper. So there's plenty of money out there, just not enough good deals for it.
Are you seeing more distressed properties out there these days?
We're seeing a lot more hit the market. There's been a lot of distress out there, but there's a saying in the lending business that a rolling loan gathers no loss. I'm helping sell 3 properties for one of my lenders because they foreclosed on them. And then, through my parent company, Marcus & Millichap, I've gotten brokers to sell the assets. So we're seeing the distress show up at the lenders.
Right. So
also, a lot of my clients are distressed, so we're having to recapitalize. We have to do a cash and refinance. You have to go find a new partner to put money into the deal just to refinance it.
Yeah, so you're kind of working all ends of the territory, it sounds like.
Yeah, but every product type: office, industrial, apartments, retail, everything.
Well, let's go through the different categories just for interest. Let's start with office being the fun area that may have the highest vacancy right now.
Well, it's all about resetting the basis. We have a client of ours who bought a property for $140 million, put about 20 into it. Then he sold it for about $250 million. That client put in about another 20, and then he bought it back all cash for $82 million. So somebody took a $160 million hit. And with that new basis in a Class A office building, he can charge lower rents than everybody else. And as we're increasing the weighted average lease term and we're leasing it up, we're going to be able to refinance it at some pretty attractive rates. The lenders are now recognizing at the right basis with the right tenants, the right underwriting, that even office is financeable today. It's a lot more expensive than multifamily, industrial, or grocery-anchored retail, but there is capital out there for office.
Yeah, okay, that's interesting. All right, so the banks are starting to see office coming in. Well, when you buy it at half the price or a third the price, it certainly helps.
It does.
Yeah.
But there's haves and have-nots. There's some price. There's some office out there that, nobody will lend on and nobody would buy because, the highest and best use is to hold the world together. It's just, there's no use to having an office building there. We're seeing some being converted into multifamily. We're seeing some buildings just being torn down for industrial. We have a client that, has an office building. His rents were so low and the value of the building, he wasn't even paying, his debt service. He bought out his tenants, tore it down, and is building industrial right now.
Wow. This is an LA property?
Yeah, it's in South Bay.
Yeah. Well, industrial in LA is still pretty good, although the tariffs have sort of put things in limbo, right?
Yeah, the tariffs have slowed the ports down, and we have a lot of big economy based around it. But once again, what's happening in the industrial marketplace? I'm very involved in industrial, National Association of Office and Industrial Parks, NAIOP. I run a forum of about 20 people in an acquisitions forum. And, we overbuilt the marketplaces, the market slowed down, the tariffs slowed things down, prices went up, and, leasing is just slower. So there's a thing called TIMS, time in market. And the tenants used to take 2 to 3 months to make a decision. Now it's taking 12 months. So
Wow.
it stay vacant for a longer term. But, industrial is still a hot product type. We're doing a $115 million loan on an industrial build-to-suit for an investment grade tenant. And, so we're still seeing a lot of leasing. It just takes slower to get that tenant to sign on the dotted line.
So, okay, so let's just for fun jump to retail. What are you seeing out there in the retail world?
Well, I have a bunch of retail I'm working on. I'm refinancing right now a outlet center, and it's in a tertiary market, and we need some recourse because, the location. We have 2 financings coming up for repositioned malls. Nobody would like to lend on a mall, but when you can buy something at a 12 to 14 cap and turn it to a 20 cap, people can lend 50% and have great coverage. And if you have, good health ratios, the rent relative to their sales, you have decent co-tenancy clauses because they've worked through all their REAs, even malls are financing. The thing that everybody loves is grocery, drug anchored shopping centers. We're getting that stuff in the perm business. Price as tight as 150 over treasuries on the perm. But once again, retail is hot right now. Street retail is catchers catch can. We did some stuff on Rodeo Drive, which is, but it was a credit tenant. So retail is hot again because, you can get positive leverage. The investors like it because you can get a cash on cash north of 7. And, people like doing retail because it's transparent. You can see how well the tenants are doing because you can look at their sales relative to their rent.
Well, except for maybe big box, right?
No, big box is good too. It's just,
Really? Wow.
we're doing power centers. We have
Really?
a client of ours who's building a number of power centers, and he's buying the land, he's selling off a big chunk of it to the anchor, and then he's building, TJX concepts of Burlington and Ross and Trader Joe's and people like that, Five Below. And there's a lot of people clamoring to do both the debt and the equity on that transaction.
Really? Wow. Okay. Well, that's new news because some of the other folks I've been talking to said no, big box is dead right now. But that's interesting to hear.
A friend of mine bought $680 million worth of big box last year. He was buying at 9 caps, now it's 7.5 caps. So he's
Wow.
increased the value of his portfolio by 20% because there's so much demand for retail right now.
Wow. That's very good news. That's good news nationwide. I knew retail was hot, but I had heard big box was not doing so great. So
No, it's the last 18 months, retail is the new preferred product type. Malls are still hard to do, but it's the power centers and the grocery drug are the most popular.
well, the neighborhood malls are doing okay, the smaller ones, right?
Yep. One
Yeah.
of the things is that the strip centers, the stuff that's adjacent to the anchor, that's become a commodity product that Pro Holdings started doing. A site did it, and now it's an accepted asset class, even just the shop space.
Wow. Okay. So what do you see out there in the famous future?
Well, I find that people haven't realized their losses yet. The banks have not marked to market. I think that a lot of the Odyssey funds, if you look at the Odyssey funds, which are the open-ended core equity funds, which is something they index against each other. So you know what core assets trade for, you know what geography they're in, and you compare that to the REITs, they're still marked incorrectly by, close to 100 basis points. The redemption queues are 17% of the, $350 billion of these open-ended funds. So until people take their marks, until the banks mark to market correctly, until the Odyssey funds, until all the private equities, until people take their marks, you're still going to have the bid-ask spread be too wide because people want to sell something at a high 4, low 5 cap. You want to buy at a 5.5 cap, 6 cap, and until you get the market unconstipated, it's not gonna flow. I'm one of my clients who owns $15 billion worth of multifamily. I'm raising some preferred equity because he can't sell the properties he owns at the price he wants, can't buy them at the price he wants. And he says, I'll own something at 80 or 85 cents on the dollar versus 100 cents on the dollar. So we've already started this preferred equity program. We're just getting new investors because it's such a profitable business.
Well, you said early on there's a lot of capital out there, but do you see people competing for properties to buy?
Yes, but once again, the price that they find when you finally have the price discovery, a lot of people aren't going to sell at that price. So it's not that there aren't properties for sale. We were on the phone yesterday with a client of mine that we're trying to take it out and says, listen, yes, it's a brand new property. It's in lease up. He's given 6 weeks free, and today it's worth about $43 million. His total capitalization is 50. So he has to not only lease it up, burn off the free rent, he has to get a little bit of rent increase, another 5% rent increase, and he'll be able to get his money out. So there's too much supply, not enough demand in some of these markets. The hot markets, they built just way too much product. As a result, in order to lease it up, you have to give away free rent. But everybody wants to lend on the stuff.
Well, that's interesting. So the lenders are ready to go. The capital's out there, but there's still a lot of pricing that hasn't really come down to the market where people want to buy it.
Yeah, the bid-ask spread's too wide because, when you look at these numbers, how much is insurance going to actually cost me? It's one thing, I'm a big institution, and I'm, and the risk is spread over, 50 properties. If I'm buying as an individual, it's to have a different insurance cost. What's my labor cost? What's, nowadays, one of the big hot topics of multifamily is, bad debt. There's a lot of fraudulent people applying for apartments, and they have, can't get people out to cost them money. So what are you putting in there for bad debt and for, legal costs? So when you underwrite conservatively, the proceeds and the values are coming down because the sponsor says, oh, this is 5% vacancy, and collection losses, because I know how to market properly. These are my expenses. And then the investors come in and say, I'm going to go to 6 or 7% on vacancy and collection losses, and I'm going to do other things like that. It's more the underwriting that's beating up the deals versus
I mean, in the industrial triple nets and even maybe the retail triple nets, you can pass those insurance and tax problems on to the client. But if your leases are true triple nets, but
even if you pass it on, what is my total occupancy cost? A friend of mine is an industrial guy, and he was in one of Rexford's, one of Blackstone's building that sold to Rexford, and all of a sudden his real estate taxes went up 2 times. And he's saying, well, my occupancy costs, I can't stay in this building when my lease renews because my total occupancy cost is going on. So yes, it gets passed on to the tenant, so the landlord didn't, but he's going to lose a tenant, and they're going to roll and find another building.
It's a fine balancing act. Wow.
Tenants can only pay so much for certain businesses.
So are you seeing some owners discount their rents just to compensate for the insurance and taxes?
Well, I mean, if you look at the office building guys, they're just trying to get tenants in there to pay their OpEx.
Right.
Downtown Los Angeles, if you look at the math, your rents are about $26, $27 net.
Wow.
Your TIs and leasing commissions are $150. So if you think about that, it takes you 6 years just to amortize your TIs and leasing commissions with zero money being paid for your for the return on the building. That's why they're tossing the keys. But in the interim, if you think that this building is something you want to keep, you're paying your OpEx. You're not losing money.
So no wonder prices are coming down, right?
Yep. That's why everything has to reset.
Wow. Wow. Well, yeah, I mean, people are taking some big hits. There's no doubt about it.
Absolutely. We have
So,
a client of ours who just bought back a building for a quarter of what he sold it for,
oh,
or a
geez.
third of what he sold it for.
Oh, wow.
Sold it for 240. They put another 20 and he just bought it back for 82 all cash, $82 million.
Yikes. Well, so, I mean, they're just taking these gigantic hits. How can they survive?
Well, that's one of the issues. That's why people aren't taking their marks. That's why the banks aren't taking their marks with the loans or other things. That's why a lot of the equity funds aren't taking their marks. But some guys, if you're at the end of a fund life, you have to take your mark so you can get what's left of your promote and get out.
Just take your losses and run, right?
Yep, go on to the next fund.
Wow. Wow. Well, it is real estate and there are cycles, so you just got to be ready for them, right?
I remember in 1992 sitting down with my mentor, George Smith, and Ray Watt. And the beginning of the conversation is where we are and what cycle and what started it and what's taken us out of the cycle. And real estate's cyclical. And if you're a young person, but you have 2 years of FU money, so when the cycle goes bad, you can survive because a lot of guys don't survive through these cycles. And it's a boom bust market. But when it's going, it's great. But just put money away into savings. Don't go out and spend it.
Yeah, oh boy. Oh, well, I think we could talk for probably another couple days. What did we miss so far?
I think the most important thing is that I'm seeing green shoots. I'm seeing net leasing. I'm seeing, nothing's being built. I'm seeing in certain marketplaces, rents escalating. It's all about supply and demand. It's basics. If you remember the Green Bay Packers, the first day they came, this is how the football, this is the line of scrimmage, this is how you block, this is how you tackle. And, supply and demand are starting to come back into equilibrium. And when you're not enough new supply of product and you're still seeing rent growth, and rent growth eventually will justify new development. So I'm starting to see the rent growth. I'm starting to see some prices come down because there's not enough people building right now. So I'm seeing the costs come down and the rents go up. And so I think that, I'm starting to see green shoots. I'm also seeing people that can't hang on any longer. I see distress. I'm seeing people saying, I'm just going to sell these assets and I'm going to clean up my balance sheet. So I'm starting to see distress with these new reset bases as people came up money with it. So I think it's exciting time. And I also think the economy is getting stronger. And I definitely think that the Fed's going to lower. And I think interest rates will come down, and that, we're a capital intensive business with a cheaper cost of capital, the values will go up.
So Jerome didn't lower prices or interest yet, or he just stayed even for the moment. When's the next reset happen?
September, but he had two of the governors, the first time since the 93 that two people have gone against the unanimous on the
Oh,
monetary.
right.
It's getting
Yeah.
pushed back. So I think that you'll see 25 to 50 basis points in September. But we have two more reports on employment and two more reports on inflation. So it depends on what happens the next 3 months to see what really happens.
So the one thing we haven't covered is just geography. So are you seeing markets? Where are you seeing markets uptick now? Florida, Texas, Chicago? What do you think the geography is looking like these days?
So I was on a conference call today. The places where there weren't oversupply. So right now the Midwest and the Northeast is a lot better. San Francisco, parts of San Francisco are starting to see rent growth. Dallas is having incredible net absorption, but they overbuilt it so much, but it just takes time to absorb, but there is absorption. Same thing with Austin. They overbuilt it, but in Phoenix, these are strong markets, but it's take another year and a half to recover. So we have a client of ours who's a multi-billionaire, and he doesn't have duration. If you have to write a 5-year pro forma, you want to buy something in Austin or in Phoenix, it's not going to pencil. But if I have unlimited duration, if I'm going to own this forever, and I can buy, at 60% of replacement cost, and you believe in the marketplace, you're going to make whole. So that's what we're seeing people do nowadays.
Yeah. Well, if you can buy below cost, that's certainly the way to go if you got money in the bank. So cash is king, right?
Yep.
All right. Well, let's end just for fun. What's your favorite food?
Oh, in Chicago, where I'm from, I always like the Italian beef with extra sweet hot peppers at this place called Mr. Beef, and that's what that TV show The Bear's about. One in Los Angeles, I like the Godmother over at Bay City Deli.
Nice, nice. And who would you like to sit with that famous beef sandwich?
I probably sit with my dad. He died when I was a kid, and I always wanted to have a real good conversation with him.
That'd be fun. That would be great. Well, okay, Gary, where can people find you?
I'm at IPA, which my email address is in my name, G Mozer, GMOZER at IPAUSA.com, and call me on my cell 310-339-7700. Really appreciate you having me on your podcast, Bruce. It's exciting times in real estate. I think it's really going to heat up over the next 24 months.
Well, I think we should talk in another 6 months and just see how the market maybe has moved over the next 6 months.
Absolutely.
Let's do it. All right. I'll
Thank you
ping
very
you
much.
in January, February. Let's reset again.
Sounds like a plan to me.
All right. Great to have you.
Thank you.
Talk to you soon.
Yep.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.